Okay, so I want to talk to y'all a little bit about the arm today, and I'm going to keep it fairly brief because the boys just told me they're making a chocolate sandwich, and I'm not sure what that entails. So I've only got a couple minutes while they're distracted, and then I need to go make sure they haven't destroyed the kitchen. Okay, so I want to talk to you a little bit about arms and pricing and how that makes sense, or when that makes sense. Of course, it always depends on strategy. I have another video where I'm going to delve into ARMs a little more in depth. And then I just made a shorter video on ARMs and why they may not be priced as competitively as you would expect. So check that one out. So the arms that I wanted to talk to you about today are Fannie Mae and Freddie Mac's arms. So some institutions have their own arm products that are priced differently and um, can be more or less competitive theoretically. But these specifically are through Fannie Mae and Freddie Mac. So, first, I am going to pull up here I ran some numbers, and so I'm going to pull them up so we can go over them. Okay, so I ran some numbers on three different ARM options. So an ARM is going to be connected to some sort of market index or the financial benchmark that lenders use uh, to calculate what the ARM adjustment would be. In this case, these three ARMs that I've pulled up are all connected to the SOFR, which is the Secured Overnight Financing Rate. Um, we have a 5-6, a 7-6, and a 10-6. So when we're looking at these arms, this first number here, 5, 7, or 10, is signifies the number of years your initial rate is going to be fixed. So the 5-6, initially it's fixed for 5 years. 7, 7 years, 10, 10 years. And then the second number indicates how often after that initial fixed period of time the rate will adjust. So in this case, it's fixed for the first 5 years. It adjusts every 6 months after that. 7 years, 6 months. 10 years, 6 months. Theoretically, the arms with the shorter initial rate period are going to be priced slightly better. And you can kind of see that in this case. So um, I will start over here at the 10-6 month ARM option. All of these are conforming. They're either Fannie or Freddie. And of course, pricing varies from day to day. And, 6 months from now, the market could be different and the arm situation could be very different. But for today, the actually highest rate available on the 10-6 month arm was 5.5%. However, it came along with quite the buy down. So that was the highest rate option you had, but you would have to pay points to get that rate. So you're paying for that rate. And what it would cost you is $29,858.50. That is the fee for that interest rate alone, 5.5%. And then that interest rate is going to be fixed for 10 years. And then if you don't refinance into a different product or sell or pay the loan off within that 10 years, then the interest rate will adjust every 6 months after that. Now, that's not always a bad thing. I mean, if you're paying attention to the market, because with an arm, your rate can go up or it can go down. So if rates have been improved, then it could result in your interest rate dropping. Um, and then, of course, if they have worsened, it could result in your interest rate going up. Either can happen over the life of the loan, and but then remember, you are free to refinance into some sort of fixed rate option. You'll just need to weigh whether or not that's um, financially beneficial for you. So then we have our 7-6 month arm. So fixed for the first 7 years. Every 6 months after that, it adjusts. And that, with that option, the highest rate available, and I'm saying the highest rate available because that's the rate at the lowest cost. So when I pulled these arms, there was nothing at par right now. There was not an option for me to offer you, 7% with no points. It was all with points. So on the 7/6 arm, we were at 6.375, and that cost would be about $18,000. You can see it's about $10,000 less than the 10/6 arm, even though the rate is higher. And then you have your 5/6 arm, so fixed for the first 5 years. This is at 5.99% for $15,000 in points. So, with these three options, then if we go and we look, here, I pulled this up. These are rates on a 30-year fixed. I mean, we can see we can also get 6% for $15,000. So if you're looking at the 5/6 option and you're looking at the 30-year fixed, in this situation, pricing is very, very similar between the two. I probably wouldn't advise that you go with the ARM because you might as well just start with a fixed rate loan. Now, the place that I found that it could start to make sense is really with the highest buy down options. So if you are just wanting to get the lowest interest rate possible and you're fine paying up front, or you need a specific interest rate to qualify for the loan, like if your debt to income ratio is rather tight and you have to have your interest rate at 5% or lower, whatever it is, that's kind of the point where some of the arms start to make a little more sense. So let's see. I am going to pull up. Um, oh, my screen share is paused. Where did I stop it at? Okay. So I'm going to see if I don't know if this is going to work or not, but I'm going to try it. Um, so here's where I see that it, like I said, it potentially could start to make sense. So here I have the 10 6-month SOFR arm, and I'm going to put it next to, and right now I'm just looking at pricing. So what does this interest rate cost? Um, And you can see if we are looking here at um, either this guy right here, the 4.875, the 4.99, and we're also going to look at the 5%. Okay. So this number here is what you're paying for that interest rate in points. And it's significant. So, you've got a chunk of money set aside to buy the interest rate down, or maybe for whatever reason you were able to negotiate some really great terms with your seller. Sometimes with the higher purchase prices, if, especially if you have a bigger down payment and you're able to negotiate even just 3%, if it's $1 million purchase price, then you have 30 grand to play with. Now, so we're going to want to weigh a lot of options, but let's say you are buying it down here, significant buy down. So this is on your 30-year fixed over here. See right there, there's a 30-year fixed. So 4.875, that's going to cost you almost 50 grand. 4.99 is going to cost you 45 thousand, and 5% is going to cost you about 45,000 as well. And if I look over here at our arm, at 5%, we're at 39,000. At 4.99%, we're at 40,000. And at 4.875, we're at 42,000. So, there's a little under a $7,000 difference on that 4.875 for the 10/6 arm option. If we that pricing is going to get a little better if we look at, if we come over here at the 7/6 arm option at that 4.875, that's going to cost us 35 grand. So, now we're saving a little bit less than 15 grand on that interest rate. And then, on our 5/6 arm, that's going to probably be the best priced option. We're at 31,000 for that 4.875. So now we're looking at 4.875, $49,000 is what it would cost you, not including any other closing costs, just for the interest rate. It would cost you $49,000 to get your rate into the fours. On the 5/6 arm, it's going to cost you 31,000. So that's where we start to see a difference. But the challenge is that that's also where, like, am I going to spend $30,000 on an interest rate that's only guaranteed for the first 5 years? Well, the answer to that really is going to be your number one, your financial strategy. Like, what is it going to save you? Where is the money coming from? Is it coming from you? Is it coming from the seller? What, and again, what are those financial plans? Like, do you know you're only going to be in the house for 5 years? Or do you just have a real good feeling about interest rates over the next 5 years? Like, what is that plan? Or do you need 4.875? Do you need that interest rate to help you qualify and get in that house? So there's lots of pieces to consider, but that's kind of where the pricing on the arms might make sense. Um, is if you have, number one, seller concessions really help. And then if you need to get that interest rate to a certain point income-wise to qualify for the loan. Um, as you can see, it takes a lot of strategy, and it really takes looking at each interest rate, comparing the fixed rate to the arm, and then deciding, like, okay, I know I have to get my interest rate to 4.875. Um, Having a that's a great interest rate right now, 4.875. So if you have the 49,000 and can fix it at 4.875, might be a while before a refinance would make sense. Um, but if most of that money is coming out of your pocket and having an extra almost, 20 grand to play with, to have at closing, to not, feel like you've spent every last dime to get in this house, that might be a place where an arm would make sense because you're not spending as much upfront to, um, you have that extra cushion in the bank. And I know, like, when I bought my house, having a little bit in the bank, because your mortgage payment theoretically is often going up, and having a cushion, or even just because you're like, I know I want to paint my house, I know there are a few updates I want to make, and I just really would feel more comfortable if I had an extra 15 grand in the bank. So I'm going to go with the arm for now. And if rates were to drop, I would want to refinance anyway, so for me this makes sense. And that's truly, I think, what it's about. It's not about getting the very lowest interest rate every single time. It's not about any one thing. It's about continuing to review and compare and just get as much, I know it's hard, but get as much knowledge as you can. Work with someone that you're comfortable with, that you can ask questions to, and really be open with what your future plans are for for this home, for your financial goals, and strategy. Okay. Hope this was helpful. And if you have any questions, please reach out to me. And yeah, I better go before my boys attack.
What?